and welcome. You're watching Business Today TV. I'm Sakshi, Batra. Well, in a big setback for mutual funds, the government has now proposed in Finance Bill that the investment in mutual funds where not more than 35% is invested in equity shares of Indian companies will now be deemed to be short-term capital gains. Now, this will apply to investments made on or after April 1st of 2023, and also debt funds held for more than 3 years will no longer enjoy indexation benefit. Additionally, they will not be eligible for 20% tax rate as well. Also, grandfathering will not be extended to market-linked debentures as well. To understand what these proposals in the finance bill really mean for AMCs at large, the mutual fund investors, also joining in today to explain to us the repercussions of this proposal is Mr. Niranjan Avasthi, Senior Vice President and Head of Product and Marketing and also Digital Business at Edelweiss AMC. Welcome, Mr. Avasthi, and thank you so much for taking the time out for this discussion. Definitely the big news of the day. I wanted to start by asking you, are asset managers such as yours really left surprised by the latest move of the Finance Ministry?
Right. Thanks, Sakshi, for having me. This is actually a surprise because, when the main budget was announced, the usual practice is to go into each and every line, look at, the details in the finance bill. But that time there was no such proposal. So, and coming at this point in time, when the finance bill is just being tabled and approved, I think so. It's a bit surprising for the entire MF industry and investors as well.
Okay, so what do you expect as the next step? Is the Association of Mutual Fund Industry really going to look at representing their views after this proposal to ask them to review this proposed amendment?
Sakshi, I'm not privy to that information, of course, but I'm sure industry will, represent, in my view, that's my personal view. And because mutual funds have been, a vehicle for many individual as well as corporate investors, a easy way to access, especially the bond market, which is very illiquid in nature. And I'm sure the role which mutual funds have been playing, especially on the debt side, should continue. And in that case, I think so there should be some, representation which will go from the AMCs and the entire group.
Right. Which funds, according to you, will be most impacted with this proposal now?
Right. So if you look at the mutual fund categories, there is a category which invest in less than 1 year, bonds or money market instruments, which includes your overnight fund, liquid fund, low duration fund, ultra short term funds, money market. All this is basically funds investing in less than 1 year instrument. Collectively, these funds account to roughly around 9 lakh crore out of total 14 lakh crores of debt fund a year. That doesn't get impacted because even today, investors who come into that category comes for a very short period of time. They any which case pay a short-term capital gain tax, and that I don't think so will get impacted. Then there is another category which is medium to short term, where you have corporate bonds, bank PSU funds, and some credit risk funds and all. That category is where most HNI investors or corporate investors come in for 3+ years to get a tax efficient return compared to any other investment products that is there in the market. That category may get impacted in terms of new inflows into this category because now most other investments compared to mutual funds, everything is at par. The taxation largely remains same, and then the money will flow in basis where the yields are attractive based on which interest rate cycles we are into. So there will be times when FD rates are yet to pick up, while debt mutual funds see a higher YTM at that point in time. Maybe that point in time people will flow in into this category. But this is broadly the category where flows may get impacted. We'll have to wait and watch, but I think so that is the category.
Right. Okay.
It's roughly
And
around 3 lakh crore.
Okay, and even as a knee jerk reaction in the stock markets today, we did see the AMC stocks plunging, and everybody now is worried that the mutual fund industry will be hit substantially, and it is a major setback to the schemes that you also have talked about, which have very strong debt portfolio. What is your understanding of how will this really change life for AMCs? What will be the impact of this as far as the total assets under management for AMCs is concerned?
Right. So different AMCs have different mix in terms of debt and equity AUM. Out of that, also how much they have into short-term and medium-term funds will decide which AMC takes how much hit. But broadly, one good thing about this thing is they have grandfathered old investments. So only new incremental investments starting from on or after 1st April 2023 will attract new taxation. The old investments and any investments done till 31st March of this year will continue to enjoy the old taxation, which does two things. One is the existing AUM of most mutual funds will remain intact. So there won't be any knee-jerk reaction in terms of outflows and all, because if someone is redeeming, it's a disincentive for that investor because that will be reinvested in some other place with much higher tax. So hence the existing AUM may remain impact. As I said, the category which is long to medium term money which comes into all that category like bank PSU, corporate bond funds and all, there the inflows will slow down a bit. To that extent, each AMC having share in that category may get impacted. However, largely if you see, most mutual funds are focused on making equity funds uh, uh, you know, uh, or reaching equity funds into retail uh, uh, client base and SIPs and all that goes on. So that is a larger part of most AMC's business, and I don't think so to that extent. Most AMCs will get impacted. Or there should be a knee-jerk reaction immediately. So
Okay.
structurally, yes, flows may uh, come down a bit in that category.
Okay, but what would you really say? What does it really mean, these amendments mean for the mutual fund investors, especially the debt mutual fund investors now?
So for debt mutual fund investors, especially looking for 3 to 5 years kind of investment, definitely now the tax, gets equalized, or the arbitrage, I would say the tax arbitrage is no more. So they need to look at the products based on other factors, whether it is liquidity, whether it is overall gross return versus maybe a traditional deposit or NCDs and all those factors will come into picture now, and then investor will have to decide. But existing investors into debt funds, they don't need to worry because all your investments, current investments are grandfathered. You don't need to redeem them. You just stay invested and redeem only when you need that money. Don't redeem. They don't need to redeem, in fact, if they want to reinvest or do anything else. So for existing investor, I think so life doesn't change.
Okay, but what happens in this case? I mean, is it a clear advantage for FDs for that matter, or equity saving funds, hybrid schemes? Will we see money flowing to these, and to which schemes do you really believe that the shift is likely to happen?
Yeah, in fact, we were just discussing at Edelweiss Mutual Fund, we are already known to have a wide basket of hybrid funds and all. I think so. Hybrid funds, you rightly pointed out, Sakshi, would be a good place for many retail investors at least, and HNI investors to take exposure to debt as well as measured exposure to equity in a much more, I would say, tax efficient as well as risk adjusted basis. So hybrid funds, whether it is balanced advantage funds, equity savings funds, uh, I think so that category becomes more appealing for many retail investors.
Hmm. Do you think that we may also see the direction of money flowing to, say, sovereign gold bonds as well, and the non-convertible debentures as well in the debt category?
Yeah, of course. Now, unfortunately, and then I think so there is still clarity awaited. Funds like gold FOF or gold ETFs also, give up their indexation benefit. as we read it today. Uh, in the lack of clarity, I think so. Customers may be better off investing in a sovereign gold bond and all. Uh, at least in the immediate future. But even the existing investor in these funds will continue to get indexation benefits. So no need to panic. But yes, incremental investments, investors will have to chalk out his own, risk adjusted basis, whether he wants liquidity, whether how the taxation impacts and all, and then take a call.
Okay. So I wanted to ask you, I mean, like, what is your sense? In the month of March, do you see inflows into debt funds rising or falling? And then in April, what do you really anticipate? Because,
I think
1st
so.
April onwards, yeah.
Yeah, next few days, we have that room available. I think so. Smart investors will, go for it and invest. In April, as I said, the short term space, the impact won't be there, which is actually the largest category in MF, which is close
Hmm.
to 9 lakh crore. But
Hmm.
in the medium term category, short term category, we may see some, uh, you know, flows slow down. That's my
Hmm.
view. But of course, we need to wait and watch. It is
Yeah.
also depending on how the other relative opportunities are and how attracting the yields are in the other space, or the other options that are available.
Okay. Also, looking forward to a larger picture now, as far as the government's decisions have come in on the debt mutual funds, just wanted to, anticipate perhaps, or just like to understand what could this really mean for the other segments as well. Is it becoming pretty clear that the government will eventually remove LTCG on listed equities and tax all the capital gains on sale of listed shares at STCG rates as per one's personal tax slab as well? What is your sense now going forward from here?
So I think so. At least this budget clearly, gives a clear path where government is trying to remove any tax arbitrage, at least on the debt or some of these instruments. We saw with MLDs where the taxation arbitrage was removed. In mutual fund, there is a tax parity now with other similar asset class, be it FDs or maybe bonds to some
Hmm.
extent.
Hmm.
Uh, in equity, however, I think so every year around the budget, as we come closer to the budget, these talks are there, whether there will be an LTCG hike or change in year from 1 year to 3 years in LTCG. Uh, we have just passed away that budget, and at least we have maybe 7, 8 months of relief that it won't change. Uh,
Yeah.
Structurally, I think so. India still is a capital hungry country. We
Hmm.
need equity capital. The household investments into equity is still very, very low compared to many other countries, developed countries. And there needs to be some, stops or some incentive for household income to come into equity. Uh, I think so. Mutual funds have done it very well via SIP over a longer period of time, which has
Hmm.
helped us to reduce our dependency on inflows from FIs and other institutional investors outside India. But I
Hmm.
think so there is a long way to go. And
Okay.
my personal view and also request is we should not be too early or do any premature change in the equity taxation. There's a long, long way, and there are a long way, to achieve that uh, equity culture in India, and that's
Sure.
where I think so. It should not and it won't change in my view.
Absolutely. Well, thank you so much, Mr. Avasthi, for being with us on the show and discussing with us all these insights to help us understand, and all our viewers as well, what the latest amendments really mean for the overall asset management companies at large, the industry, and also for the mutual fund investors, because this will give them a clarity to really understand, find out how should they be really positioning their investments going forward from here on, and from 1st of April, how do they really approach their debt investments, the fixed income instruments, as well as their FDs, and the investments in the other asset classes as well. Many thanks for joining us.
Thank you, Sakshi.
All right, and with that, we wrap up this edition. Definitely big news coming, in today's trading session, the finance bill amendments, which is definitely a big blow on the debt mutual funds. But we will have to wait to watch and find out whether there is any representation coming in from the Association of Mutual Fund Industry in India to the government to really, push them to have a relook at these amendments, whether that happens or not, and what could be the repercussions for the debt funds going forward and the investments right there. Will we see the inflows reducing in debt funds going forward and money flow shifting to other segments is something that we'll keep an eye out on. And to track all of that development, you should stay with us on Business Today TV. Don't forget to subscribe to this channel, and also you can continue to engage with us on our other social media platforms like Facebook, Twitter, LinkedIn and Instagram. Until then, many thanks for tuning in.